Welcome back to another distribution announcement video, and we have quite a few changes this month for both distribution increases and decreases. And in this month's video, I've added another tab to also include Ninepoint's ETF distributions as well. So there's a bit more to go over now, but as long as it's helpful for everyone, I don't mind doing it. Again, don't forget to subscribe and to like the video so that you don't miss out on any future videos and updates. The goal is still to reach 5,000 subscribers by the end of the year, and we're just past the halfway mark of 2026 now. And with that, let's now get into the distribution announcements. Before we start, all of this is being recorded on July 25th, which is on the Saturday. Also a note that all of the following observations are just my own guesses as to why there might have been a distribution increase or decrease. There are a lot of moving parts when it comes to arriving at these final distribution amounts that the funds ultimately decide on. So starting off, the first one we'll go over distributions for is Purpose Investments. And here we have 3 increases, 3 decreases, and then 1 newly released ETF this month. For YAVG, it is a 20% increase to the distribution, going from 50 cents to 60 cents. Pulling up the chart, and then switching to the 1-month view, Broadcom has remained basically flat during this time. So, while based on that, it isn't all that impressive, but when we look at it from a year-to-date perspective, it is up a respectable 10.35%. I say respectable here, because if you actually look at it from the bottom earlier this year on March 30th until June 2nd, the stock has actually increased 64.13% over this time period. And with all that volatility, it likely translated into higher options premiums, and not to mention also the growth of the underlying portfolio. So a mix of these elements, along with some other details, may have enabled them to announce such a significant increase for the month. A similar thing can be said for MSFY, where on the 1 month, Microsoft is up 4.44%, but year to date it's actually down negative 21.07%. This could again be the same recent increase in the implied volatility over the last few months as we saw with Broadcom earlier, where Microsoft's stock price rose 29.08% and peaking on June 1st. And during this basically 1 month sell-off, because there weren't any big bounces or recovery, most, if not close to all of their covered calls, probably expired worthless, meaning they likely won all of their contracts without getting called away on any shares. So, with typically close to 50% coverage of their portfolio, this is a scenario where the strategy could have shined the most. Once again, I'm just speculating, and that there are a lot of moving parts, so some of this could have contributed, but there may have been other factors as well. Then next, we have YGOG with a 8.30% increase, going from 60 cents to 65 cents. Looking at the 1-month chart, you'll see that it was doing fine up until the last few weeks, where it started trending downwards until today. A lot of this decline was in the most recent week, where Google had their Q2 earnings on July 22nd after the market close. They posted amazing numbers and passed everything with flying colors, but the stock still dropped negative 7% afterwards. And this was likely due to the increase in expected spending on AI, to the point that this was the first quarter since going public that Google has ever reported negative free cash flow in its history. This means that they are spending more money than they are making, and many investors didn't appear to like that. But taking a look at the bigger picture and looking out, Google is up 2.15% year to date. And going even further out, it is up about 66% in the past 1 year. So this has been a big winner, considering the overall size of the company relative to all the others. And despite maybe a little bit lower of a return so far this year, there is still probably a lot of upside still captured in their underlying holding. As for the negatives, we first have Netflix. There's not much to be said if we just look at the charts, where on the 1 month it is down minus 2.44%, and year to date it is down minus 25.25%. At first, this decline was mostly due to their bid for Warner Bros. Discovery, but then soon transitioned to some projected slowdown in revenue, viewership, and an increased competition for content. It looks quite a bit worse too, when we look at the 1-year chart, where it's down roughly 40% now. So as a result, it looks like YNET will be dropping from a 30-cent distribution to a 25-cent distribution going forward. The next would be Palantir, and like Netflix, it has been hit particularly hard this year. Though on the 1 month, it has seen some recovery and is currently up 8.30%. And year to date, it is down minus 30.85% so far. So as a result, YPLT has dropped its distribution by 16.70%, going from 60 cents to 50 cents. Finally, the last decrease here is going to be from YTSL, where these numbers also look quite ugly. On the 1-month chart, you'll see something similar to Google from earlier, where it was doing fine and then it dropped significantly in the past week. This is again due to them also reporting their Q2 earnings on the same day as Google. And while their revenue numbers were showing signs of improving, they missed on many of the other numbers, and were also negative free cash flow like Google due to the AI spend. This triggered a minus 14.50% sell-off in the stock, making it one of the worst drops in a single day for Tesla. So these large red numbers over time likely prompted them to finally decrease the distribution from 60 cents to 55 cents, or a minus 8.30% drop. I'm not going to go over this next one because it's not a covered call ETF, but it looks like they've released a new ETF called PGRX, which focuses on a diversified portfolio of global resource companies that could be interesting if you're looking for some exposure in your portfolios. Quickly scrolling down a bit so you can see the rest of the distributions that have stayed the same. We'll next move on to Evolve ETFs and their distribution changes. There are typically no changes, as Evolve tends to keep their distributions quite stable. They've also been holding on to the reputation of not having any distribution decreases as well. So when we do get a change, it's usually in the form of an increase, and that is going to be the case here for both Bank and SIXY. The Canadian banks have done extremely well in the past year, significantly beating both the S&P 500 and the Nasdaq indexes. Looking at the chart, HBNK, which is an equal weight ETF of all the Canadian banks, has gone up 61.53% in the past 1 year. Then for the Nasdaq, we are using QQC.F, which is the Canadian dollar hedged version of the Nasdaq index, and that has increased by only 18.42% in the past year. As for the S&P 500, we can use VSP, which is also a Canadian dollar hedged version of the S&P 500 index, and it has increased by only 13.97% in the past year. So, while this performance isn't going to be identical for Bank and SIXY, it does show you how strongly the banks have increased in the last year. Looking first at Bank, just keep in mind that for these ETFs, it will be just looking at the price return, and not total returns on the charts. For the past month, Bank has gone up 3.20%, and for the year to date, it is up 23.01%. Bank has 4 life insurance companies as well in its underlying holdings, which have also done well lately. So overall, the ETF as a whole has been a great performer, and is why they were able to increase the distribution again after only just increasing it 2 months ago. As for SIXY, this one differs a bit, and is strictly holding just the big 6 Canadian banks. On the 1 month, it is up 1.35%, and then year to date, it is up 18.94%. As a result, Evolve was able to raise the distribution by 28.60%, going from 21 cents to 27 cents. Again, for these charts, they are price return values, and do not include the distributions that have also been paid out. So the actual total returns will be higher than what you see here. Otherwise, that's all the distributions for Evolve, and next we can move on to Harvest ETFs. For Harvest, this one is quite simple, and they just have the one ETF in HGR, which is their REIT Leaders Income ETF, that saw a decrease of 34.50%, going from 4.58 cents to 3 cents. This is a global REIT ETF, so it's a bit hard to track and pinpoint exactly why there is a decrease in the distribution. But generally, REITs haven't exactly performed all that well in the past year or so, and that might be why there is a decrease for this fund. I'll also scroll down a bit so you can see the rest of the ETFs. Next, we'll go over the Harvest High Income shares. This month it looks like there are a lot to go through, so I'll try to keep it a bit shorter for these ones. There's also some overlap as well with some of the ones I've already gone over in the Purpose Investments section. So first, there's Johnson & Johnson, and this was a 25% increase going from 12 cents to 15 cents. Pulling up the chart, on the 1 month it has been fairly good, going up by 9.29%. And on the year to date, it is up 27.28%. Then if we zoom out to the 1 year, it is up even more, at about a 60% gain in the past year. So this has been a great performer, and a possible reason why for this increase. Next, we'll have AMD, and this is actually the 3rd month in a row of increases, with a total of 4 increases now for this year. On the 1 month chart, it doesn't look all that impressive, but on the year to date is where you'll see why it's had so many increases, where it has gone up 143.72% in just the past 6 months. And so, that's why they were able to increase the distribution by another 21.10% this month, going from 95 cents to $1.15. For those who own HHIS, AMD has been the best performer among its 20 holdings, and without it, things would definitely look much more bleak in terms of its overall performance. Block is the next one with an increase, with its distribution increasing by 16.70% and going from 24 cents to 28 cents. Looking at the charts, on the 1 month it's up 1.94%, and then year to date it is up 18.53%. So this has been a steady performer, and has done well enough to warrant an increase to its distribution. Then there are the two Amazon ETFs, in AMZH and AMHE. This one is a bit puzzling to me, as I own Amazon in my own portfolio, and I can't say it has been a great performer this year, as you can also see in the charts. On the 1 month, it is down negative 0.92%, which is almost flat, and then year to date, it is up 0.56%, which isn't anything amazing to be excited about. Though I suppose it did sneakily make a 52-week and all-time high a couple months ago, before it traded down to where it is now. But in any case, for AMZH, it is a 14.30% increase, with the distribution going from 14 cents to 16 cents. And for AMHE, it is an 11.10% increase, with the distribution going from 18 cents to 20 cents. Next, there is Eli Lilly, and for LLHE, it is increasing its distribution by 12.10%, going from 16.5 cents to 18.5 cents. For LLYH, it is a 6.70% increase, going from 15 cents to 16 cents. This has been a decent performer lately, where on the 1 month it is up 7.05%. Then on the year-to-date chart, it is up a bit higher at 11.29%. Much of the gain was made in the past 2 months, so we'll see if it can continue this going forward. Moving on to CrowdStrike now, this is another one of the better performing stocks within HHIS. In the past month, it is up a good amount at 8.93%, with the year-to-date being a 56.40% increase in price. So with this performance, it is also going to be the 3rd month in a row that they'll be increasing the distribution for this ETF. This time, it'll be a 12.10% increase, going from 33 cents to 37 cents. And lastly, for the increases, we'll go over Apple. For the 1 month, it is up 13.63%. And for year to date, it is up a fair amount at 22.50%. If you're not familiar, Apple has been somewhat of a laggard to the whole AI game, and chose to not massively spend to compete with all the other Magnificent 7 companies. And as a result of this, they seem to have been rewarded by the market a bit lately, as you can see by the chart, where they are basically at or near their all-time highs for the stock. So we'll have to see in time if, in Apple fashion, they can find their own way to eventually compete when it comes to utilizing more AI in their products and services. But right now, it seems like the market is in favor of their more cautious approach when it comes to CapEx spending. So for APLE, it'll be a 10% increase to its distribution, going from 20 cents to 22 cents. And with that, we'll now move on to the distribution decreases. For Netflix and Tesla, it'll be the same reasons as I've already discussed at the beginning with purpose investments, so I'll skip over these when it comes to the explanation. But for NFLY, it is a negative 28.60% decrease, going from 14 cents to 10 cents. And for TSLY, it is a negative 21.20% decrease, going from 19 cents to 15 cents. After this, we have Oracle with a minus 20% decrease, and the distribution going from 25 cents to 20 cents. Looking at the charts, this has been somewhat of a wild ride this year for the stock. On the 1 month chart, it is down a lot at negative 27%, but then it gets even worse when you look at it on the year-to-date chart, where it is down negative 41% so far. The interesting part though with how it's performed this year is that from the start of the year to the peak on June 1st, the stock was actually up quite a bit at 27.32%. Then it all started to unravel very quickly, and in just the past 2 months it has sold off negative 51.68% from that June 1st peak, and in turn, flipped into the negatives for the year. I have to say that is quite the wild ride, and we'll just have to see if it continues to go down more, or maybe it'll soon start to recover. For the Canadian side of things, there looks to be 2 decreases this month. The first of which will be Cameco, dropping negative 18.90%, going from 37 cents to 30 cents. By looking at the 1-month chart, you can see that it hasn't been pretty and has gone down negative 18.36%, which has been all of their gains so far year to date, and then a little bit extra, causing the year-to-date return to now be negative 1.44%. The other Canadian one seeing a decrease would be Agnico Eagle. If you own gold or a gold producer ETF like this one, you'll know it hasn't done well lately after its strong rally at the beginning of the year. This past month, it is down another negative 6.16%, and it is now down negative 12.01% year to date. And as a result, the distribution has been cut negative 16.70%, dropping from 30 cents to 25 cents. I'll now quickly scroll down so that you can also see all the other distributions as well. Hopefully by going through some of these examples, you can see that when investing into single stock covered call ETFs, it's still important to follow the underlying companies held within each of these funds. While the overall return profile will change slightly because of the options overlay, major events like earnings can still have a meaningful impact when it comes to timing your investments, or reinvestment of distributions like we've just seen for Google and Tesla. And this is where the sponsor of today's video, Moomoo Canada, can help. For example, with Apple, which we just saw had a distribution increase, has its earnings coming up soon. So I can select it from my watch list in the Moomoo app to open its stock page, and then tap Fundamentals to get to the Financial section. And right here at the top is where you can view the Q3 2026 estimates by selecting it. This will then bring the company's key earnings information together all into one place. If its next earnings date is available, I can select the icon here to add it to my calendar to receive a notification when it happens. From there, I can review what analysts are expecting for metrics such as revenue, net profit, and earnings per share. I can also look at analyst ratings, valuation data, and how the stock reacted around previous earnings releases. So, as you can see here, the last earnings was positive and ended up on the higher end of the expected move. As for this upcoming earnings, we could expect somewhere between a plus or minus 3.72% move for this earnings report on July 30th. Of course, this information can't tell us exactly how the stock will react or perform, but you'll get a better understanding of market expectations, what risks or factors are currently impacting the stock, and ultimately it'll link back to the covered call ETF as a whole. If you'd like to try Moomoo, eligible new Canadian users who sign up through my link below and make a net deposit of at least $1,000 can currently receive 10 chances to draw for 10 free shares among a prize pool that includes shares from companies such as Nvidia, Microsoft, and Tesla. And for users who make an $8,000 net deposit, they can get up to 30 chances to draw for 30 free shares. Thanks again to Moomoo Canada for sponsoring this video, and now let's continue with the distribution announcements. Now, for Hamilton ETFs. As per usual, there are a lot of smaller adjustments to many of the yield maximizer ETFs. But there's some good news among all the distribution changes, and that's that HDIV and HYLD have both increased their distributions again for the 4th month in a row. It isn't normal where we see so many raises consecutively, and also in a month where SMAX and QMAX have actually lowered their distributions. This is worth mentioning, because SMAX and QMAX together account for about 72% of the allocation within HYLD, and QMAX accounts for approximately 13% within HDIV. So what this could mean is that there was a slight broadening in the market in order to compensate for the decreases. And you can sort of see this in the number of yield maximizer ETFs that saw distribution raises this month, such as EMAX, HUTS, HCAL, LMAX, RMAX, CMAX, UMAX, and FMAX. All of these sectors are outside of the Mag 7 or technology sector type of stocks, and are from various other diverse sectors of the market. So with all these changes, HYLD gets a 0.60% raise, going from 16.2 cents to 16.3 cents. And for HDIV, it goes up 0.50% and is going from a 19.2 cent distribution to a 19.3 cent distribution for next month. Then for decreases, aside from SMAX and QMAX, which I've already mentioned, AMAX and IMAX have also seen a slight decrease in their distributions. Scrolling down, we can see the other distributions, and then also all the semi-monthly ETFs at the bottom. All of these change from month to month, and for this month we have both B Day and C Day getting raises, while Q Day and S Day have some decreases. For B Day, this is just the second distribution, as the ETF only came out a few weeks ago. But here we'll have a 4.30% increase, going from 18.5 cents to 19.3 cents. And for C-Day, this will also be the 4th month in a row, where it gets an increase to its distribution. This time, it's a 1.50% increase, going from 20.5 cents to 20.8 cents. Now going back up to the top, we'll move on to Ninepoint, which is a new addition to the video this month. For this one, there aren't any major changes, with just one increase to their CNR covered call ETF, going from 8 cents to 10 cents, for a 25% increase. If I pull up the chart for CNR, it looks like on the 1 month it is up 10.85%. And then year to date it is up quite a bit at 34.74%. That is quite surprising to me, because I recall that the railroads have underperformed for quite some time in the past couple of years, so seeing it recover here was a bit unexpected. But otherwise, we can now move on to the last tab, and that is for Global X. I think for here, we'll have a lot of happy investors that are going to be pleased with the increases this month. Many of their popular index ETFs, like USCL, QQCL, EQCL, RSCL, CANL, and HEQL, are all seeing increases. And then some of their sector favorite ones like BNKL, HBNK, BKCL, and ENCL are also going to see increases as well. In general, it's a bit more difficult to predict or know when Global X raises or lowers their distributions, but I think this time around seeing these raises is a welcome sight for many people. There are also 2 decreases though, and that would be in GLCL and RNCL. Gold, as already mentioned, has been taking a hit over the last few months, so that's to be expected. For telecommunications, they have been bad investments overall and have continued the trend for this year, so there's no surprise that they ended up having a cut in the distribution. I'll scroll down so you can see the rest of the distributions, and here at the bottom we'll also have the semi-monthly distributions as well. With these, it looks like BCCL will be the only one seeing a decrease of negative 5.90%, going from 17 cents to 16 cents. Hopefully, Bitcoin can start to see a recovery soon and head back towards their highs later on in the year. And with that, it wraps up all of the announcements for this month. Because there were many more changes this month, it took a bit longer to get through all of them. But for those who made it this far, let me know if it was worthwhile to include all the other added information. Or would it be better for this video to come out sooner and just strictly go through the numbers themselves? Let me know in the comment section below if you can, as I want to make these videos useful but also in a timely manner. Don't forget to subscribe if you haven't yet. And with that, I'll see you in the next video.